Thank you all for joining. We're going to give everyone one more minute and then we will get started. All right. Thank you so much for joining. My name is Alicia Hurt. I am the executive director and founder for I See My Baby. We have a women's wellness center in rural Bainbridge, Georgia. And a part of what we do is support women and families on their journey navigating life, which includes stability. And housing is the key to that stability. Well, recently we had rolled out this series in two parts. And we had the pleasure of having the city of Bainbridge present. And they did share with us that we are able to do almost 20 USDA loans, which is 100% financing, which is a major win for low to moderate income families that are looking to become homeowners. I've been able to close those loans in the state of Maryland and actually have seen families walk away with money when they close, not having to bring a check to the table. And so we put together this home ownership presentation to enlighten, to give you a pathway forward and to help you understand that you are not alone in navigating this journey and it is attainable. Especially now, as we're preparing to receive our tax funds, we're trying to figure out what to do, how to do it. And let's be frank, we are in so like uncertain times, but I want to be that constant. I want to be that glimmer of hope to tell you that we can still achieve the goals and the dreams and the desires of our hearts, to move not just us forward, to move generations to come forward. And so that is why we are here to talk about a new path to home ownership. I am also a realtor. I'm licensed in the state of Maryland and also in the state of Georgia. If you are watching this and you are in any other state, please do not disconnect. I do have a team with women and men that work all over the US and even internationally that can support you. So listen to the information. If you need a deeper dive or want to do a one-on-one, there will be slides in here, especially at the ending. But you can reach out to me at Alicia Hertz, my first and last name.com, and schedule your 15-minute clarity call. So let's dive right in. And this is part one of a two-part series. So you're ready to find the perfect home for your family. Maybe you're an investor. Maybe you purchased before. One of my first books, I talked about how I purchased at 21, lost that home, filed bankruptcy, and then started all the way over. So I always tell my clients and those that I come in contact with that there are no judgment here. It's just results. Life happens, but we're here to help you with that pathway forward. So not every potential homeowner is able to qualify for a traditional mortgage, and it can sometimes be hard to find a solution or a know where to go and how to turn and who to talk to. And so having someone that have lived it, but then also has the expertise behind it will help you to reassure that you can come up with a strategy to become a homeowner. And just for statistics states, sake, millions of Americans, they rent their homes despite the long-term benefits of owning. And as you can see, 44 million. And this, I believe, is about roughly 2 years old. So I'm sure the number has increased. Whereas 40 times there's a wealth gap of renters to homeowners, and we're looking to close that gap. And our mission is to guide people on their unique path to home ownership. Remember that every decision that we make is geared towards guiding renters on their path to home ownership. And what clients need to know about rent to own. That is a popular term. I've actually gone through it, and it's in my book about overcoming my opportunity or obstacles, I should say, of losing my home. But we had to go the route, which is non-traditional, of rent to own in order to become a homeowner for that second time around. And typically those programs, they're looking at least a 550. Some have increased those credit scores after COVID hit. So now they're more trending upwards to the 600 mark. At least 44,000 a year in income. You need to have at least 3,000 saved in your bank, because if you think about traditional renting, you need to have at least a month to a month and a half, and no bankruptcies, because they want to make sure that you are have a sound financial background if you're going into a program like that. So what type of homes do they purchase for rent to own? So usually they stay within that 500K mark. It has to be ready to move in. And I want to pause really quickly. Give me 1 second, because I believe that we're jumping ahead. So pardon me. I believe this was part 2, because we need to actually start with credit. So my apologies. Give me 1 second. Let me pull that up, because I need you to understand the basics. This was from the last one we just did. Keys to home ownership. I mean, this is good information too, but I need you to also focus on, first off, is the credit. Here we go. This is it. This is it. Here it is. Okay. So let me back up. I got ahead of myself. I'm just so excited. I'm so excited, y'all. Here we go. I was like, wait a minute, we talking mortgage already? This is part 1. Okay, so let me jump to the part that is relevant. Credit. So credit confidence starts here, and unlocking your potential. So that's me, y'all. And this is my broker, my mortgage lender and partner. She is in the Atlanta area. I also partner with the local banks here in Bainbridge, Georgia. So whatever floats your boat, I have a partner for you. But Marquita is just the bomb. I love Marquita. But credit for home buying. So let's understand about credit. What does it mean? How is it categorized? How to identify what those 5 C's of credit is. What is it? What does it talk about? And also how we evaluate your credit reports. Again, non-traditional versus the traditional banking, and strategies to build or improve your credit. And I do have a credit repair specialist that can support you in making sure you have a good understanding of the credit requirements and what you need to do to repair your credit. So the 5 C's of credit. So the first one is your character. It determines basically, who are you? When you think about your character, that's what your credit is saying. Who are you? right? Even though life happens, they judge you based on that one score. The capacity. What is your ability to repay that loan? Collateral, like what you have, what are you bringing to the table? What can you use to secure the loan? Capital, the borrower's personal investment in the property. So you'll learn later on that some mortgage tools or products, you may have to bring a 3% or 5%, or like I talked about briefly in the beginning, USDA, where you may not have to bring anything to that table to close. That's capital. Conditions. What are the conditions and the factors, like the purpose of the loan, the interest rate? What are those conditions? And that makes up the 5 C's of credit, which are factors that lenders will consider when reviewing loan eligibility. And it breaks it down some more. And if you are one to say, you know what, Alicia, this sounds good, but I need some one-on-one support, that's fine. Reach out to me and I will connect you to Miss Davis, Miss Vicki Davis, our credit guru, and she can support you and help you devise a plan. So when we talk about your credit report, a lot of people will automatically say, oh, I'm going to pull it from Credit Karma. Credit Karma is okay, but it's not giving you a true depiction of what your score is. And also, a mortgage lender will pull a different report than, say, a credit card person or someone looking to purchase a vehicle and finance a vehicle. They pull various reports on you, and there are different types of credit scores. Remember that your credit report, it shares information from banks, lenders, investors, your landlord, businesses, governments, like when you're getting a job, all of that, all that detailed information is analyzed, and that comes up with, are you credit worthy? Even for your insurance, your, like I said, employment, your business needs, even certain licenses, real estate, things of that sort. If you're doing security license, insurance, they pull your report. So it is very, very important to understand what is on your credit report and some questions to ask when applying for credit. And I want to pause for a second. I want you to understand that when you're shopping, it does not mean that you need to have your credit pulled by multiple people. You don't want that. What you want to do is to be a savvy consumer, meaning I'm coming through the door knowing what my credit score is. And you can do that by pulling your own score through annual free credit report. You can pull one annually for free from all 3 credit bureaus. You can also go directly to those bureaus and pull your report as well. So that way you understand what is on your credit report. And they have all different type of simulators now. If you go onto Google and pull up the mortgage calculator, it'll help you to understand, well, if my score is this, then what's the likelihood of, just say, like a Wells Fargo of a Bank of America, what would they possibly or potentially lend to me? And that can kind of help you get a sense as well. But you want to know, what is the annual fee? What is it going to cost me? What is the percentage rate, the APR, right? Which are 2 very different things. When are the payments due? What is the minimum payment required? And these are some really good things that you can use across the board, whether it's for a credit card, whether it's for a car loan, student loans. You can use these questions to really help you understand credit and what it will cost you to take out that loan using your credit. The credit limits, what your penalties are for late or missed payments. Also, what are the terms and the conditions of the credit, and what else is included in that fine print. And this is just showing you the whole amount of what makes up your credit report scoring. So as you can see, a bigger chunk of it, 30% of it, is that amount owed. And that payment history. Those take up a big chunk of what your score is. Also, the length of your credit history. So the longer you've had the account, the better it is reporting. Like, you know what? Alicia can be trusted. She's had this account for 10 years. And she has paid it on time. That's showing that whole time there's a stability with her, and we are wanting to lend to her. And it helps to boost and to keep your credit score up. Okay. Also, the red, it talks about the types of credit that you have. That brings up 10%. And then new credit, that's 10% of your score. All right, so payment history. We could go a little deeper into payment history. So that is your payments timely, right? Your payments timely, that helps to increase your score. Missed payments, that will drop your score drastically. Payments in collections, that will drop your score, right? And any payment that went through collections and have been paid off while still on your report, it stays there for 7 years. 7 years. Are you currently struggling to make payments? Considering contacting your creditors and trying to work something out so that way it is not reporting negative. All right. The next one, okay, there it is. It is amount owed, right? So you want to try to pay off your debt rather than moving it around. So you may say, you know what? I'm going to say my Wells Fargo card, I'm going to open up a Bank of America one and I'm going to just transfer that balance. No, don't do that. Try to pay it down. Unused credit cards. So you don't want to close those. You don't want to close them. That's a short-term strategy to decrease your overall available credit. So if you say, you know what, I'm not using this card, so I'm gonna just close it, I'm gonna just shut it down. Whereas you can keep it there and it'll help with your overall amount that you're using, your credit usage. Also, adding new credit. You don't want to open new credit cards to increase your available credit. So consider following the 30% rule, meaning if you have a card, you want to make sure you're only using about 30% of the balance. So if your card is $1,000, you only want to use $300, right? You don't want to go up 4, 5, and 6. That will hurt your credit. You want to use different types of credit. So consider the impacts of it. If you have, let's say, an auto loan, you don't want more than one because that's showing that you may be overextending yourself based on your debt to income ratio. Same with home mortgages, right? And it depends. If you're an investor, then you will have more than one. So it just really depends on your situation. And the best advice I can give you is to seek wise counsel. Even if you're going and saying, you know what, I'm going to be an investor, because we may say, hey, your strategy might be to get an LLC, get a business, and put the property in that name instead of then getting another mortgage in your personal name. And also that speaks to the credit cards as well. Rent payments may be used to build credit. We see that a lot. My previous business in Maryland was property management, and we had a function in the system where my tenants could buy into a program that it will show when they made on-time payments to help their credit. So that's a great way. If you're currently renting, you can reach out to your landlord and say, hey, do you participate in this? Or look up a reputable company. And if you need any suggestions, you can reach out to me. There are a couple that I would refer you to where they would then confirm with your landlord that your payments are being made on time. And then that can show to help improve your credit. But remember, if you're late, then that will decrease your credit score. Also using your credit cards and opening credit cards. Don't open credit cards under your children's name. I don't like all of that. Now, if you want to help your children, that is a different strategy where you would add them as an authorized user. But even in that, I would caution you. You need to understand the strategy before you just go out and do it. The length of your credit history, I kind of touched on it before, but you want to make sure that closing an account, it doesn't make it go away. It's just inactive. And old accounts in good standing should not be closed because you need to show your longevity. You need to show that you're a great steward, right? Even if you're not using it, even, you just leave it there. Leave it there. It's better to leave it there than to just close it. You always want to talk to your mortgage rep before making any of these decisions, especially when you are trying to get a loan. Also, your revolving credit cards. It should be used every 6 months to remain active and healthy, but pay them off. So whether it's you going to the store and getting gas and pay it off, use the card every so often so it won't go dormant. And with new credit, when you apply for and open new credit accounts, you only do that as needed. And you should not do that when you are attempting to acquire a mortgage unless it is a part of the strategy that your mortgage specialist has given you. You want to reestablish your credit history if you've had problems by thoughtfully taking out new lines of credit. And a lot of times that will be through a secure card where you put the money up and that is the limit on your card. We did have to do that after I filed bankruptcy many, many years ago in order for me to reestablish myself, reaffirm myself as being a better steward in order to then qualify for a mortgage. You want to know the cost of credit. There is a cost. And there are three things that you need to identify and understand. What is the principal? How much am I getting? So if it's $100, that's your principal, right? What is the interest? So if they say, okay, we're going to charge you 5% on that $100. And now what is the fee? Well, in order to give you the $100, you're going to pay me $10 for the application fee and $20 more to close on this loan to give you. That's the fees. Three separate things, and you need to understand what they are before you say, yes, give me the money. Give it to me. So here are some credit facts. So you want checking or pulling your own credit score or report. It does not hurt you. It does not lower your score. It is called a self-inquiry. But credit inquiries made by companies checking your credit, where they want to send you a pre-approval offer, or they don't count. They're soft hits. And sometimes they'll tell you that. And if you have an alert on your credit report, you'll still get an alert. Hey, Alicia LLC checks your credit as a soft hit. But you want to be very clear that it's a soft hit because you don't want a hard hit, a hard inquiry. Like if you accept the credit card offer, if you're going in there doing the application and it's like, all right, hit submit to submit this application, that's a hard hit and it does count towards an inquiry on your credit. Each credit inquiry can lower your score by about 5 points. And if you are like teetering on that line, okay, you got that 580, you like, hey, I can go, let's get this loan. And then you get an inquiry, there's not much wiggle room there if you keep getting multiple inquiries. So the FICO system counts multiple inquiries made in 14 days period as one inquiry. So if you're out shopping for a mortgage, shopping for a home, a car loan, they're like, yep, that's what she's doing. So we're not going to keep dinging her every single time. We get it, but it's in that 14-day window. So you go longer than that and say, all right, I'm going to try again. Then they're likely to hit you with that 5-point decrease on your credit score. So understanding your credit report. So all credit reports have the same information. All your personal, identifying your birth date, your address, social, employment, all your credit history is there. Your public records about any bankruptcy, foreclosure, judgments, or liens. Also all your inquiries. And the good thing about that is every 2 years, they drop off. So this time, 2 years ago, if you had an inquiry, it would drop off of your report. And so that's why it's important to at least once a year get a free credit report to see if it's something more than 7 years old, make sure that it's dropping off, or submit a letter and say, hey, this needs to go. Same for the inquiry. And they pretty much do a good job at it, but you need to stay on it. It's your report. So remember earlier, I was saying every 12 months, you can get a free report. Here's the information for the 3 credit bureaus, or you can go to annualcreditreport.com and it will take you to each of the 3 bureaus. And it is free of charge, no charge, no charge. So there are websites that have abbreviated websites on it, and then you have to pay a fee. So just make sure you're going to the right site and that you're not being charged to get your credit report. And here's a sample credit report. This is a lot of information, I know. But the key things that you want to look at is on this screen. Number one, make sure that date of birth is correct, that it is you. Make sure your essential contact information is correct. Like my husband, his brother and him have similar names. And so a lot of times we have to send dispute letters because they may put something from his brother on his credit report and vice versa. You want to look at your fraud alerts. Make sure all of that information is accurate. Look at your public records, any collection accounts. So wait a minute, the hospital bill, what's that? Do your research. And if you have an online copy versus a hard copy, if you have an online copy right in the system, you can dispute. And before you dispute it, if you're looking to get a loan, you need to talk to your lender and say, hey, I want to dispute this, because many a times a lender would tell you you can't have disputes in the process of trying to obtain a loan. Also, the manner of payments, making sure that that is correct as well for every single creditor, every single creditor. And if there's a missed payment, first you call them. Hey, Mr. Creditor, this is incorrect. I need for you to fix it. How long would it take? What is the confirmation number? When should I follow up? Can you send me something in writing? And then you follow up with them. And again, I kind of went into a process of correcting the errors on your credit report. So you must collect evidence to dispute these errors either online or by mail. And the good thing is there are so many different letters with AI that can help you, even YouTube. If you need more guidance, like I said, you can reach out to me. I can help you with that. We have reporting agencies. They have 30 days to verify, hey, is this true what Alicia's saying? Is this incorrect? Is this an error? And will temporarily exclude it from your credit score. And so if it takes longer than 30 days for Alicia LLC to confirm, then guess what? It's coming off your report because they have 30 days. So if an error is removed, you can ask that it's correct, the corrected version be sent to you, so that way you can have it for your record. So reporting negative information. So here's the type of negative information that can be reported, and then the max time, the max time that it will stay on your report. So general civil judgment, 7 years from the date filed. Tax lien, 7 years from the date paid. Okay. Chapter 13 bankruptcy, 7 years. Now, if you do a chapter 7 or any other bankruptcy, that would stay on for 10 years. Now, with a bankruptcy, after 3 years, you can purchase another home after 3 years, but it still will remain on your credit, and they will probably ask you for your discharge paperwork to verify the timeline. So if you want to improve your personal credit scores, you must pay your loans and your bills on time. Put that in the chat. On time. Pay your bills on time. Meaning, hey, pay it before time so that it's on time. Avoid any judgments, any tax liens. Call these people, make arrangements. They will work with you. You need to talk to them. Also, comparison shop for financial services. Don't just take what Alicia LLC Credit is saying. Shop around. And that does not mean you all hit my credit. No, but shop around. What are the rates? What does your product come with? What are the ins and outs? What are the fees associated with it? Ask those questions similar to what we were discussing earlier. And keep older accounts and pay them off monthly. Pay them off. So if it's an old account, you've had it for 10 years or so, guess what? Keep it and pay them off monthly, because it is helping your credit score. And there's some questions that you want to ask yourself again before applying for funding. I want you to put at the top, call Alicia. I'm going to say call Alicia because that's easier to remember than all of these different questions here. But it's important to know. It's important to know. So how long have you been on your job? That's a part of funding. How much money do you make each month? That's a part of your debt to income ratio, because then the next question is, what are your monthly expenses? So if you only bring in $1,000, how can you afford a $1,500 mortgage, right? And then you also have your expenses, which are $700. So you're underwater. You can't do that. So it has to make sense. You say, okay, I bring in $1,000. My bills are only $150. So I can have a mortgage for $600, right? And I will be fine. So if you think of it in that way, you say, okay, now I understand, why they may say no to me. How much money do you have in your checking and savings account? Are you able to pay the loan even if you don't work? Say if you out of work or you furloughed, like just happened with the federal government, right? Are you financially sound that you can still meet your obligations? Do you own your house? Because some loans, they may say, hey, we can do a secured loan and your house could be your collateral. Do you have investments or assets? Have you had credit in the past? How many credit accounts do you have? Have you been denied credit? Have you ever filed bankruptcy? Have you had any outstanding judgments, property repossessed, or foreclosed on? And have you ever made late payments? Now, I'm going to tell you this. Life happens. So, okay, you had a late payment 6 months ago. As long as you're able to write a letter of explanation, I have lenders that will work with you. And you say, okay, well, there was a hiccup, or we had a financial hardship, and then you can show the rest of that 6 months you were fine. Your credit score still is in line with their criteria. Chances are you will be able to still obtain that loan. But you got to be able to put your story together. It has to make sense. Hey, my husband was sick, my wife was sick, right? It's not just cut and dry, especially in today's funding world. But you have to communicate and let them know what is going on with you. The biggest part is give your lenders the paperwork that they need and build that relationship based on trust. You got to be able to trust your lender. The lender has to be able to trust you, because honestly, they're going to find out, right? They're going to find out. So let them know and understand how your scores work. You want to learn to think like a lender and ask tough questions, and it's okay. Buying a house is one of the most important investments that you will do in your lifetime. So guess what? Ask the tough questions. So this is my information here. We usually, if we were in person, we would take a pause. And if there are any questions, feel free to put them in the chat and I will answer them. And this just goes up on with what we do as an organization, as a nonprofit, how to reach out to us, going to our website, things of that sort. We're going to dive into the mortgage part. Let's see what time we have. Okay, good. We're doing good on time. We're doing good on time. All right. So again, here's Marquita. And so we want you to have the confidence with us to move into your dream home, even if you do not qualify for the mortgage yet. Okay. And I started all of this in the beginning so I can keep on going. See how it flows through? You see? You see? All right. So I was speaking to rent to own process. And the reason why I was speaking to it is because, like I told you before, come on, let me go back. I had to do rent to own when I filed bankruptcy and we lost our first home. Shortly after, I was able to then buy another home through the rent to own program. And the rent to own program, you can do it with an individual, which I have seen that a lot here in Georgia. I was like, okay, where there are individual landlords that offer that opportunity to their tenants. One in particular said after making 18 payments on time, which is 18 months, then we will automatically go into a rent to own contract. I was like, this is awesome. I've also worked with programs, companies that were hedge funds that would buy properties and then do the same thing, but just a company would purchase the home for you. And if you're interested in it, just let me know. We can schedule time. We can talk about it. And then they would essentially do the same thing. You put up your deposit similar to what you would do when you rent the home, and that money would then go directly to your deposit to purchase the home. And then every month that you pay, say your rent is $1,500, you may pay $1,750 or $1,850, and that difference will go towards the purchase of the home. Okay, how the application process works with that, you will apply and you become pre-qualified. They collect all of your financial documents similar to when you're purchasing a home. And then they give you a budget. They'll say, okay, Alicia, you were approved for 500,000 or you approved for 200,000. You would then come to me, the realtor, and say, hey, they said I can do this. And then we would go and based on the criteria of the home and the company, we would then find you a house. A lot of times they have pre-screened houses on their website, or as a realtor, they would say, hey, and most times you go through some type of certification. So you know for that organization what they will buy. The house may not be older than 20, 30 years old. It may not need a whole lot of repairs. Like those are the stipulations, those are the criteria. And then they normally the more sophisticated companies, you can put the address into their system and it'll tell you right away, hey, Alicia, you can go and show this house. We will buy this house. You find the house, you put the offer in. As the realtor, I will put the offer in, and I will put the offer in on behalf of the rent-to-own organization that's buying it for you, not you as the buyer or tenant, I should say. And then they accept the offer, great. And then you will be a part of the inspection process, the appraisal process. They close on the loan, and then you get to move in. And again, you pay your rent and you paid a little increased amount so that way that goes towards your deposit and purchasing the house. So that's rent to own. That's a non-traditional way of being able to purchase your house if you're unable to just purchase it flat out. And I use myself in this example where I had to wait my 3 years, and I wanted to be able to be a homeowner again. I went through the rent to own program, and I actually went through rent to own with a individual person in Baltimore. We lived in Baltimore. We purchased that house, and then we did it again when we moved back to PG County and bought a house in Charles. No, we did not buy that house in Charles County. We ended up backing out because the cost of the house was not big enough. Our family was growing. And so we needed a bigger house than the one that we were going to buy through the rent to own program. And that's another caveat to it. You're able to walk away. You're able to walk away. And sometimes you lose your deposit, but that's just the name of the game. I much rather lose this small amount than buy a house that is too small and won't suit my family. All right, so now we're getting into traditional home borrower guides, how it works when you're getting a home. So here are 6 reasons to buy a house. And hopefully, I don't have to convince you that you're actually listening, watching this, because you have already made your mind up that I want to purchase a house. So the first thing is prices will continue to rise, and that is a fact. It will continue to rise no matter who's in office. Listen, real estate will appreciate. Okay, real estate will appreciate. Put that in the chat. Real estate will appreciate. Okay, so mortgage rates are always going to change. It's not going to be constant. So you may say, "Hey, I'm gonna wait till it." No, no, no. It's going to change. And what I would tell you is, you're going to marry the house and you're going to date the rate. So you may not like what the rate is right now. However, I promise you it will change. And then you can refinance and you can love that rate. Okay. Whether you're renting or purchasing, someone is paying the mortgage. That is so true. Somebody's paying it. So why not you? Why not you? Right? Owning is a form of forced savings. And there are tax benefits to owning a home. Yes, it is. Glory, hallelujah. That is one of the things that our current president, he got it right. We got so many benefits this year to write off, okay, based on what he wrote, based on his mandates, right? So it behooves you to be a homeowner because you can write those things off. I just had to do some renovations. I had to do this new roof. I had to do, and when tax time come, you let your tax person know and you can write those things off. Lastly, it's time to have a place to call home, yours. You may feel comfortable where you are, but it is not yours. Okay, it is not yours. You want to avoid the rising rent trap. And I have seen some things with the rental prices. And I'm like, okay, even as a professional, as a realtor, I can't understand. the differences in these prices. Like, where are these prices coming from? Well, you can get away from that. You can say, this is my mortgage. This is how much I paid for my house. And guess what? I don't have to worry about it going up unless you have a balloon loan, which we can talk about at a later time. But you know, this is my payments. This is how much I pay in my escrow, which is your water and your taxes and things. It is constant, and you are not getting stuck in that rent trap. Okay. And yes, there are legal parameters around it about how much more, landlords can charge you or what have you, but still, it is still a rising rent trap. You want to ensure that as we look around us, that one of the truest and longstanding notions in the U.S. is the opportunity of land. Okay. So with that fixed sentiment, the American dream of home ownership is still continues to exist to this day. It exists, the American dream. Home prices are rising, not expected. They're rising. They're rising all over, right? Whether you're planning on relocating to a different area of the country, or if you're planning to stay in your current city or state, waiting to move may end up costing you more than you think, more than you think. So you want to keep that in mind, especially I know on social media, there's a lot of talk about how the cost of living is going up, but my pay is not really increasing. Even if I get that 3% increase, I still can't keep up. But if you keep on waiting, it's going to be worse. It's going to be worse. And these are stats from 2016 and 2017 talking about the rise of 4.7. I'm sure if we pull more stats, more recent, you'll be like, oh, MG, I get it. I need to purchase sooner than later. The cost of waiting, you can see it. So say today the mortgage is 250, right? There's the interest rate, there's the payment. And then you wait for years to come. There is the payment, the mortgage 263, the increase, the interest rate 4.7, right? And there's your monthly payment and your interest. And here's your cost. Your per month cost, your per year cost, and then, okay, typically you do a 30-year mortgage. That's your cost for waiting. Do you want to wait? No, right? No, no. And there's power in equity. So as the economy continues to improve, more and more and more Americans are seeing their personal finance situation improving as well. You may be saying, slightly, it's still improvement. So instead of just getting by, many are now beginning to save and find other ways to build their net worth. One way to drastically increase their family wealth is through real estate. It's through real estate. Shout out to my coach and my mentor, Dr. Tamika Bryant. Years ago, she was like, here's the calculator, here's the formula to help you understand how to plan for your retirement and using real estate. How many houses do you need? First off, how much money do you need to retire? Now that was an eye-opener. Then you say, okay, how I'm gonna get it? Real estate is a great way to do it through land acquisition, right? So if you have someone in your family that passes away and they have property, try your level best to hold on to it as long as possible. If anybody has played Monopoly, you understand it. You want to hold on to that property as long as you can. Now, if you got to cash out, you got to cash out, but you should be coming up. So if you paid, I remember my parents' first house they bought, they paid about 60 something thousand for the house in Landover, Maryland, in Palmer Park, to be exact, on Normandy Road. Shout out. And if you go there now, because I was there a few years back, and you drive around, I'm like, some of the areas look just the same. And you see some of the houses that have been developed, you see some new development, but people are paying well into the high 200,000 mark for that house. And I'm like, man, if I'd have knew that, I'd have been like, hold on to the house, hold on to the house. Because even if I needed to cash out now, the difference between the 60,000 and 200,000, that's at least 140, at least 120 after closing or what have you, that you can walk away with. So there is power in equity. Hold on to it, right? Even if it's the sake of the land itself, there's value in the land. Over a 5-year period, a homeowner can build their home equity over 40,000. In many cases, home equity is a large portion of a family's overall net worth. All right, here we go. So 43,198, right? That potential growth in that family's wealth. Look at it. So in 2016, you bought the house for 250. The assessment will come out. And every year when you buy your house, you'll get a tax assessment, no matter where you are. And they'll tell you what your house assessed for. Even your lender will send it to you because they want you to refinance, right? And they'll say, hey, did you know your house is worth 260 now? After a year. Okay. You know, it went up another almost $10,000 a year later. Okay. All right. And it just keeps going and it keeps going and it keeps going and it keeps going. That's real estate. So why not be a part of that? Whereas as a renter, the price is going up, but you're not seeing the benefit. Yes, you have a place to stay, but you're not creating that generational wealth that can help you in the long run. Because even if you retire and you're like, you know, Alicia, I may have to sell my house, that's fine. Because remember, you only paid 250 for it. So say if you sell it in 2021, you're walking away with $43,000. Could you have been able to save that on your own? And more people will probably say no. No. So this can be your savings that you can cash out. And then there are different products like reverse mortgages where elderly people would do it to help them survive until they die because their end game is saying, I don't need this house. The bank can have a house when I die, but allow me to live comfortably and pay me based on the money. So using that same 43,000 based on what I have in my house. Pay me. And then when I pass away, you can have a house. You know, my family don't need it. They're self-sufficient. Or even if you ain't worried about your family, I'm worried about me. That's another way to think through your wealth building and how to be comfortable and using and leveraging real estate. So here are some of the items that you need. So remember in the beginning, we started talking about credit. So we only get to this point about qualifying because we know we have the credit score. We know we have it, right? That's why it's at the bottom, number 6. We know we have that 580 to that 800 credit score, right? We're ready. You've talked to Alicia or she's referred you to a credit person and you've worked through your strategy. And so now you're ready to purchase that home, right? So here are the items that you'll need. Down payment. So whether you're doing the USDA loan, which I have been talking about with regards to Bainbridge, being able to buy in the city of Bainbridge, Georgia, or even in the county. But in the city, I'm just excited about because you can do almost 20 loans now before they say no more USDA loans in the city. You do put down something, right? 500,000, whatever, as you know, for that. But then you will likely get that back when you close. Also, if you do a traditional loan, FHA or what have you, conventional, typically is 3 to 5%, which you bring to the closing table. You either wire it or you bring a check, depending on what the title company, which is the organization that will help you to close on your loan, making sure all your records are clear, the house is cleared, there are no issues or what have you with the paperwork. You will bring that to them to close your house. So make sure you have that 3 to 5% in your bank account. Your income verification, making sure you have your pay stubs. Some lenders may want to send a letter directly to your employer for them to fill out. They may call them and do a verification through a third party. Your asset documentation, so access to your bank statements. Some organizations may do something electronic, like be able to have you log in and then they're able to download the information to prove what you have as an asset. Whether you're borrowing money from a family member, they may have a gift letter to say, hey, I'm going to put up Alicia's part of her down payment and I have this amount. And they may even ask you to provide a statement to show that they have that amount. Appraisal, which is how much is the value of the home. And you'll get that as you find and identify a home, then you have someone to go out and run a report based on the area, the condition of the home, the bathrooms, the square footage. This is how much this house is worth. And the point of an appraisal is to say if the bank is lending 250, that house needs to be either worth 250 or more. And that's not to say if it's worth less, you can't do the deal. There are just some nuances with that because you may have to come up with the difference or the seller may have to come up with the difference. And that is a little more complex. However, I've dealt with it or the price of the house has to be renegotiated. Also, making sure you have stable income. that you won't get paid today and then maybe not tomorrow. That is a steady method of being paid. And again, that good credit history, but we've already gone through that. So you coming to the table ready. All right, we have 9 more minutes, and then we will pick up where we've left off our next session. So what you need to do. So number one, find out your current credit history and your score, right? Anyone remember what we talked about pulling that report at annual credit report for free? Or going to the three bureaus directly, gathering all of your documents. And if you're preparing for taxes, you already have it. And generally, they ask you for at least 2 years of income verification, at least two. Some may ask for three, right? If you're a business owner and there are different financing for business owners, right? That, hey, you may not need as many docs you personally, but you may need more on your business side. So making sure you have all of your documentation because they're going to ask you for it. Also, contacting a professional like me. Hey, Alicia, I'm ready. Who should I reach out to, right? And consult with them and talk to them. Get your pre-approval letter because that is your ticket to say, I am ready to shop. Let's go look for a house. I've had many a calls. I like this house on 123 Main Street, Alicia. Can we go see it? And the answer is no, because you'll fall in love with it. And probably by the time you get pre-approved, it will not be on the market. And now you fell in love with a house that you cannot get, right? So you don't want to do things backwards. You want to be able to get your pre-approval letter. We know how much you can shop for, and then we go and we shop. You want to know your options because it will definitely make your mortgage process easier. Your dream home may already be within your reach. All you have to do is qualify. All you have to do is qualify. This right here says 550. There are some lenders that will lend. Typically, I like to stay in the 580 range because things happen. Things happen. So if we stand at 580 to 600, we know that you're in good shape. And again, you can buy a house with as little as 3% down. If you're doing USDA financing, guess what? It's a big goose egg because it's 100% financing. Also, there are grant funding out there for you, like Georgia Dream and a few other organizations that are offering grants to close on your loan. That's free money that you do not have to bring to the table to close on your loan. And remember, you need to save, 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 save. So even if you don't have to come to the table with the down payment, you still need to save. You still need to save because at buying a house, you can buy it, you can close on it, you can go through your inspection. And this recently happened with one of my clients. The water heater went up and they reached out to me and I said, well, hey, that happens as a homeowner. You've been in this house now, how many months? 6 months. But it's on you. It's on you. Luckily, I always advise my clients to get a homeowner's policy. And so with a homeowner's policy, then that's something we can educate you on. It will cover major things in your house. And most times you just pay a small nominal fee of maybe $500, $1,000, depending on the type of insurance or protection that you purchase. That way you don't have to come out your pocket with so much money. But saving $150 a month, that's a big deal because after 36 months, that's $5,400. It adds up. It really does. And so if you're purchasing a house for 150,000, right? And your down payment for FHA loan is 3.5%, guess what? 5,250. You got that. You can do it. You can do it. So think if you double that amount within 36 months, that's $10,500. But you got to stay to it. And we know life happens. You may have to dip in it or what have you, but we're talking about extra money, right? Discretionary money. So, as we wrap up, I'm going to ask you this question. Did you know that real estate continues to be seen as the best investments? The best investments. And that's where I'm going to close today. And I'm going to thank you all for tuning in. Thank you for tuning in. And hopefully, I didn't have your mind spinning too much. But if you have questions, please reach out to me. Again, it's Alicia Hertz, ALICIAHURTT.com. And let's talk through it. I may have people here that's listening now or listening to the replay that say, hey, Alicia, I got my score. I'm ready. Let's do it. I may have someone to say, hey, Alicia, I don't know my score, but I'm going to go pull it and then we can talk about it. Let's do it. Maybe someone to say, Alicia, I already know you're not even going to finance me bubblegum. I need help. Reach out to me. Let's do it. I am here as your resource, right? As your servant leader. I love to see when you can go from A to Z. And I got the keys in my hand. Literally, I'm like this. I got your keys. I can't wait. I can't wait. It will change your life. So, again, thank you for tuning in. Tell a friend. You are welcome. You are so welcome. And I can't wait to see you on part two. You all have a good night on purpose. Love you.